This video will be longer than usual since I wanted to give a summary of what has happened in the past few years and then give a summary about the recent events. So for anyone who's just interested in recent events, feel free to skip ahead. We do have an FOMC meeting coming up on Tuesday and Wednesday, then the press conference obviously following on Wednesday. And my thinking is the Fed has to come out hawkish because if they do not, we'll see the dollar continue to fall, which we will see commodities and stock price, equity prices continue to rise. If that's the case, then that will put more upward pressure on inflation, and that will make their job harder when it comes to later on, and they have to come back, pivot back to be hawkish again, and in order to avoid that, they have to stay strong. I do want to give a shout out to my friend who noticed that I have a horrible mic, and he was kind enough to, buy me a nice mic. Hopefully, this makes the sound a lot better. So these are the topics that we'll be going over today. Again, like I mentioned, I'll be talking over kind of what happened recently with the timeline summary, what's different this time, and then going forward. And then for the second half of this video, we'll be going over more of the other kind of more recent topics. So first topic for timeline summary. So at the aftermath of 2000 and 2008, we saw the introduction of zero interest rate in both, in 2000s and then in 2008 again. And then QE with Ben Bernanke after 2008 with QE by US Fed. And that has inflated another bubble after another has popped, trying to kick the can down the road. And with the COVID pandemic, with the economic cycle was already showing weakness since 2008, which is why we saw the Fed pivot in 2019 instead of continuing their QT and continuing with rate hikes. We saw them already started easing before any COVID pandemic has begun. And with the pandemic shutdown in 2020 early, we saw that provided an excuse for the Fed to further increase their QE and cut rates to zero again. And then the late 2020 to 2021 recovery, that was artificially created by the massive spending in money supply. And that's what we saw when it comes to, goods and services consumption that was way out of whack in terms of previous years average. And that makes sense when it comes to people staying, changing their lifestyles, work from home, they're buying a bunch of stuff to improve their home, but these are kind of your one-time purchases. You're not going to buy a Peloton every year. You're buying one for maybe 10 15 years. But what happens is a lot of these companies again assumed that this is going to be an ongoing annual increase instead of a one-time impulse. So that's why we saw all these companies all of a sudden have feeling, supply chain issues, spending a lot of money into building up inventory because they were short for quite a while. While now realizing that, hey, wait a minute, economy wasn't good starting 2018. It was just a massive money spray that really helped them, last a few more years. But now, 2022, 2023, now we're seeing, the weakness come back because there's not enough sustaining money spray everywhere. So kind of in summary, we didn't really have the real recession each time because of easy monetary policy always coming in to inflate another bubble, giving the false impression that economy is doing good, companies, no longer laying off people spending more than they should have, not saving. But in fact, the business cycle wasn't allowed to really fully complete, again, which is kind of the Fed's kind of what they want to do, where they want to slow down the overheating economy while try to help bad economy pick up. But what they end up doing is actually exacerbating both the overheating and also the downside. And what happens is because we don't let bad companies, these zombie companies, go bankrupt, and what happens throughout the whole bankruptcy structure, you have someone with a better capital structured companies take over in their place. And similar to some customers, meaning people shouldn't have, for example, bought a fancy car or a fancy home. um, these people needed to be wiped out in order for the whole economy um, to kind of filled with better capital structure participants. And there's also a difference in leverage, people taking on a lot more leverage because it was a lot cheaper to do so. So now let's talk about what's different this time. Now, inflation, nowadays it means rise in prices for consumer, the consumer basket CPI. But inflation used to mean the increase of money supply, but have since changed to the rise in prices. If you think about it, and the word itself, prices don't inflate, prices rise while money supply does. And they pretty much did that with by the central bankers um, because they wanted people to stop thinking about money supply. And so that's kind of where that change came in. And there's also another thing of deglobalization, the supply shock. In order to have inflation, like now the definition nowadays, which is the rise in prices and rise in CPI, um, the increase of money supply alone is not sufficient. You need to have a supply constraint. In 2000 and 2008, we did not have that. In addition, with China entering into the World Trade Organization in 2001, it brought in a huge amount of much cheaper labor and productivity to, ensure that there was no supply constraint. So it allowed for countries like U.S. to load up on debt and focus on consumption, which we can see in terms of the trade deficit between U.S. and China. And the inflation occurred mainly in financial market and real estates because there wasn't really a place to go when it comes to the money supply increase. So a lot of it just went into financial markets, and that's why you saw the kind of widening of wealth gap, because the rich people have more assets, they're able to borrow more, and they have more financial assets, and that's why they benefited more than the poor. Instead, now, because again, money is being sent to everyone, and there's a supply shock initially due to the shutdown, and then now more on other reasons like deglobalization, and also countries restricting their commodities export in order to because they don't want to send out all these goods for U.S. treasuries that and have to accept U.S. exporting their inflation. And in addition, there's also geopolitical risks, and there's also a lack of sustainable reinvestment. I've talked about this before when it comes to energy, for example. And the reason for that is we're telling these oil companies to that hey, you're going to be obsolete in like 5-10 years, right? We're getting rid of you. We don't need you anymore. When it comes to financiers like banks, they're no longer interested in financing these companies. And so instead of making reinvestment in drilling more holes for more oil, for example, they're just keeping the money and they're paying it out as dividends and stock buybacks. Because hey, why should I dig a hole, put a refinery, and make all these investment that is at least a minimum like 15-20 year payback period if you're telling me I'm going to be gone in 5 years? So a lot of companies are no longer making these long-term sustainable reinvestment, and that's why the supply cannot react quickly, because again, these are big long-term projects that you can't just ask them to pump more, right? It just doesn't happen. There's a cap. And these are the factors that are contributing to the supply shock for everyday consumer spending. Now going forward, so a few more factors. U.S. dollar is losing the global currency status. We can already see this with different countries continue to move away from U.S. dollar. You know, Russia, obviously a big one. They've completely gone, without U.S. dollar, even with their oil trade. They take rubles only for natural gas and oil from, non-friendly countries. We see China, who's shrinking their U.S. Treasury holdings massively. Japan's the only one that's still holds. They're now the biggest holder. It used to be China, and what we're seeing is these countries will likely peg their currencies to their domestic commodities. I talked about this in the Bretton Woods 3 video, and what that means is they are going to tie their currency to the main commodities that they're producing. For Brazil, Argentina, maybe soybean and agriculture goods. For India, maybe wheat. Russia, oil, natural gas, etc. And another thing is U.S. is trying to restart its manufacturing sector. So U.S. knows that this global trend is happening, and it has begun to take an active role in restarting its manufacturing sector. It knows that countries are not willing to just fully support its consumption anymore. So that means U.S. has to produce itself in order to have a surplus to spend on spending, because people aren't willing to lend you money so easily anymore. And so it's taking industries from EU, because again we talked about this before, where higher natural gas prices is causing a lot of the industries too costly. And who else have natural gas? US LNG. And so US is trying to maintain its own natural gas supply and trying to restart these industries that are coming from EU. And it's also trying to focus on what is the next biggest industry, manufacturing industry, which is semiconductor. So it's taken Taiwan Semiconductor, convince them to move their factory into US as well. And what that means is that there will be less trades going on. Everyone's going to focus first on self satisfying domestic demand first. Whenever possible, obviously you will have some trades, but with US starting its own manufacturing, US wages are going to be much higher than some of the other places, maybe Taiwan for example, and that means the cost will also increase, or at least there's an upward pressure on that. And these are the inflation factors. Some of these factors are not changing. Like, unless they reverse course, the prices are not falling. And with deglobalization moving away from the US dollar, the lack of long-term commodities, sustainable reinvestment for, increase of production, labor market tightness, we need to see more layoff in order for like in the higher skill level, your tech companies that hired too much, expecting that one-time impulse demand was sustainable. Right, we need to continue seeing more layoffs, and for those workers to come down to meet the lower skill level end in order for the labor market tightness to potentially improve. And also we're seeing the stagflation storm continues to brew, and that's why the Fed cannot waver early, because if they waver early, then the inflation expectation will come back. People will think like, oh, economy is great because the Fed is easing again, more easy money, so we can go back out and spending and not focus on saving and more long term. So if the Fed waver early, what happens is all that will reverse course, and also they'll lose credibility. Next, let's talk about the US CPI report most recently for December. 6.5% year over year, as expected by the market. It is down 0.6% for year over year, which is why the market was very excited. Energy contributed to negative 0.45%. That's already big, but oil prices are up in January, and another big contributor was secondhand cars, which is down. Like it contributed negative 0.25%. But how much more can a rate of decrease fall this month when it comes to secondhand cars? We'll see, quite shortly here. And that means that with these two contributing, a whopping negative 0.7%, but it's only down 0.6%. That means other prices are up in order to meet, the ending of 0.6% down. And for example, owner's equivalent rent, they can fall with real estate prices, but you're not going to fall by much because, for these homeowners, like renters, assuming they have a mortgage, well, mortgage rates went up, so that means the cost for landlords have increased. Medical costs are, starting to pick up from previous decline, again, with population aging. And we also mentioned that the calculation in the CPI for medical costs is, what is collected when it comes to, medical premiums, that's their revenue, and costs. Well, with COVID shutdown, not a lot of people went to these doctors. But now that, we're starting to reopen back up and people, haven't gone to doctors for, maybe not as often as they usually do, what if they start going back again? Then that means medical costs will increase. U.S. Agriculture Department also warns, agriculture prices as supply scales back, right? So that's another contributing factor when it comes to the CPI basket. And because commodities, work in the cycle, we already saw the big drawdown previously, and I'm expecting, the next potential commodities rally like this year, 2023, kind of second half. That's what I'm expecting. So we'll see if that will be, like, we have already seen like a slight recovery, but I think, a more sustainable, strong rally, that's the kind of timing on it. And we continue to see the base year effects because we see that October 2021 is at 6.2% to, June 2022 of a 9.1%. So there's a big you have a big step up. And that's why we're seeing, when you look at year over year, because you're comparing to a higher level, that it is reasonable for the year over year figure to be lower, because we're unless you're increasing like massively, 9.1%, even on a 9.1%, that's a lot, right? So even though prices are increasing, again, we need to always kind of separate these two ideas, that prices can increase but at decreasing rate. So unless the CPI comes out negative, we won't see prices fall. So just because we have a lower inflation number, we shouldn't be happy about it. Like, sure, you should be happier than a higher inflation number, but unless we see a negative, prices won't be falling. If we take comparison to 2019 prices, that's when I think we will see a better picture. Instead of comparing just year over year, we should just compare to 2019, before the whole thing happened, where the highest inflation point was 2022 October versus 2019 October. There's an increase of 5.01% on a year over year basis. But when we take a look at 2022 December and 2019 December, the increase is 4.9%. So meaning the difference, inflation rate is decreasing, but so slow. It is at 0.1% per month. That means inflation, if you take on like a big scale over 3 years, it is not slowing down from 2022 October to 2022 December. Right? We're slowing down 0.1% per month. How long until we get it back, until the 2% target of the Fed, what they're claiming? For the next FOMC meeting, this Wednesday, well, Tuesday and Wednesday, but Wednesday is the press conference and the announcement. Bank of Canada already came out first on January 25th last week. They announced a 25 basis point hike, but here's the key. They're noting that they're pausing rate hikes in order to observe the effects since they're still doing QT, and this is providing a hope for the market that the Fed would do the same because Canada is potentially leading U.S., but Canada is a commodity exporter. It's more impacted by falling commodities prices. So it is possible that Canada is feeling the pressure, a lot more pressure from commodities sector since we saw the drawdown, that it has decided to act early when it comes to pausing rates. For the Fed, market is priced in for another 25 basis point hike, and maybe one more after this, maybe another 25 basis point before the Fed will begin pausing rates. Now, the higher equities market rally, the harder it is to see lower inflation, as the market's not willing to price in recession. We need to see a change in the sentiment. And a more hawkish Fed might be it, because again, if we're painting a rosy picture, hey, look, economy must be good, equity prices are up, like it changes the behavior of everyone involved, consumers, market participants. And so that's why we kind of need to see a realization, a market clearing kind of reflect all of that. Now let's talk about the US dollar. So it broke an important support of 103 for the DXY US dollar index. If the Fed loses to pressure, meaning it comes out only doing 25 basis point and it does not follow up with more hawkish statements in the press conference. So they can do just 25 basis point, but if they come out with more hawkish statements, then that will still support the dollar. Now, if they don't do that, DXY will continue to fall, stock and commodities will continue to rally, and that again is more upward pressure when it comes to inflation. And then if that's the case, then the Fed has to come back again to be more hawkish to make up for the lack of hawkishness causing the fall in dollar, causing commodities to rally. And the only way to avoid all of that is to avoid pivoting back and forth, is to just remain strong and stay the course. And so again, we will see if the Fed will do that. And now I want to talk about something on the side with CLOs, collateralized loan obligation. It's pretty much the same thing with CDOs. Back then it was more mortgages, now it's just junk bonds, and it's just full of garbage. Issuers again doing the same thing with CDOs. They're packaging a basket of junk bonds. Obviously you have your different ratings, but by packaging them, they're saying, hey, now they're diversified, even though each one of them are still junk bonds. Like that should, like if you have a bunch of triple Bs or a bunch of triple Cs, when you package them together, how would they be ranked double A or triple A? That doesn't make sense. If you have a bunch of triple Cs, the result is still a triple C. And obviously, like some of them do, like some triple A's, some triple B's, some triple C's, and they group them together, and then they try to say like, hey, now it's all well diversified. Maybe it's like a double A, right? So you kind of bring up the triple C's and triple B's. Well, what's the problem? When rates are low, investors seek yield. It's very difficult, especially when it comes to those who have a mandatory requirement when it comes to their return. For example, pension funds, a little hint, UK pension fund, and they're willing to take on the risk and even leverage up to buy these CLOs. And we saw to the point where some, like the sellers back then, have to refuse some buyers because they just don't have enough. And as drug dealer rule, like number one, you shouldn't take your own drugs. Some issuers even leveraged up to buy their own CLOs to keep the issuing market going. And but what has changed? Well, now rates are much higher. Investors are dumping these CLOs because, hey, why am I taking on additional risk for like, maybe 100 basis point, right? I can just go out there and buy something with much higher quality now, um, and I don't have to take on so much risk. And some of these issuers who have bought these CLOs themselves, um, and not just as dealers, because if they just if they were only dealers, they buy up all these junk bonds, they package them and they sell them as CLOs, and take the issuing fees. Their hands are clean. There's nothing. They don't take any inventory. But because they have taken them, the dealers themselves are in trouble because investors are no longer buying these, and that's probably why we saw the Fed going into the junk bond, buying junk bonds, because that's how bad that market was, and now we're seeing why. And liquidity is already an issue. And if some of these junk bonds, like mortgages back then in 2008, starts defaulting, well, we can only look at the same thing, for example, like what happened. So we'll see what happens, if this whole thing will really blow up. All the junk bonds, and with recession going on, can some of these companies really, like, will they actually default? And if they do, we'll see. Now let's talk about market clearing. So again, once the market realizes that the rates need to be higher for longer, again, because if the Fed pivot back and forth, we'll see dollar falling, we'll see commodities rising, and that will put upward pressure and inflation, and then the Fed has to come back to deal with all that issue in order, like, to be more hawkish. And instead of pivoting back and forth, it would make more sense for the Fed to just stay the course. Again, all that is my personal stipulation. We'll see if that's the case in Wednesday. And due to the stickiness of inflation rates, like I've talked about all the different factors, so we don't see prices falling. In there's no supporting catalyst for a significant price fall. And how slow it is falling. Again, we talked about how, like, on a month-to-month basis, they're falling by 0.1%. That's not enough when it comes to October of 2022 to December 2022, and we need the rate of increase to be much lower. Again, we need to always separate. Are we talking about price? Are we talking about inflation rate? Until we see a negative inflation rate, prices won't fall. They'll just rise at a slower rate, even if inflation rate is falling, but not negative. And again, the market has to price in recession. Like, there's no way to go around it if we look at the yield curve, and the market is still rewarding CEOs for laying off workers. Meaning, yes, it makes sense, to have a more slim machine, reducing costs. And we see the equity prices surge after a lot of the recent layoff announcements. But what we need to see is that the market is pricing in, hey, this company must not be doing well because they have to lay off staff, and once you lay off staff, it's not easy to find these people again, because in a few months, like, they have to find something else to do, they have to find some other job, and it's not that easy. So usually firing staff is the last thing you want to do, and they're going to that decision, and that means things must not be good. And so we need to see more shift from your tech cyclical sector to more value sector, utilities, and once we see that shift, that's when I think the market clearing will happen.